first idea here is Johnson & Johnson.
Okay, which one was Johnson and which one was Johnson when they started the? Okay, so we like this as a trader. We've been talking about some of these stocks that have been, kind of stuck in a trading range, and this is a beautiful example of one. Again, this is one of these stocks that even a 5-year-old could trade, and that's why I'm perfect for this job, because that's my mental capacity. So this stock, you buy it at the bottom and you sell it at the top. Any questions? $170 or so, maybe 180 is your target, and somewhere around 160-ish is your buy point. It seems to be bouncing off of that again. I think it'll go to 170 or there and abouts, and then, get out.
Okay, next idea is Nutrien. This has been something of a disappointment for investors.
Yeah, now we have traded this stock, and so I'm gonna take this off. So we've been in and out of it, and we got out. Actually, it started around over here, and we got out around here, but we just rebought it a couple months ago. So, in fact, I think I did use it as one of my top picks a few months ago. But it's after kind of breaking out, seems to be that's a little bit of a blip up. And so long as it's early, so we've got one leg in the stock. But if it kind of holds this last low, which I think Craig, our fundamental guy, is saying that there's enough fundamentals behind the company to suggest that it will, that we will continue legging into the stock. We don't mind the look of it at all. It looks to me like the downtrend may be ending, needs to consolidate a little bit more before we go in with both feet, but we definitely have a toe in the water on this stock, and we're optimistic, let's put it that way.
And just a stock like this that was highly touted, we had a lot of guests coming on saying, I love Nutrien, and the stock has not done very much. So it peaked out there at about $125 early in 2022.
Yeah.
Is that a ceiling? People think, well, I'm back to that peak, I'm getting out.
Well, I mean, yeah, we sold it at that level because of the old resistance levels and stuff. But
sure.
We like the stock here, and that's I'm talking right now. I'm only interested in the here and now.
Yes.
What happened yesterday? So what happened yesterday guides us as far as where like resistance levels, like targets can come in, but we're a long way off of that right now. So what I would say is if this managed to break out of this little hopeful consolidation, you've got levels ahead of you, and you got to watch each one of those levels as a potential target. And we don't. As Howard Marks likes to say, you don't predict, you do prepare, right? That's a famous saying that Howard Marks says. And so I'm not going to predict where it will go, but I will say that if it can break this level right here, it will probably get into the 110 level, and then we'll see after that. But that's a pretty good profit if it does that. And that's all we can say, one step at a time.
Okay. And then here's another cautious one, the Horizons High Interest Savings ETF, cash on the TSX. Is this akin to a money market fund?
Yes, it is. So if you see the chart on this thing, I love this chart. So everybody's like, what's that? So, you have to explain it. I've explained it a couple times on the show before. That it accumulates, because all it does is it buys a whole bunch of high interest savings accounts, okay? And then it accumulates the dividend, and then it pays it out. And then it accumulates the next month, and then it pays it out. So it's like, that's why the stock, and I don't know what's with that. Honestly, I don't know why that's on the chart. But the stock basically pays, it's not a stock, it's just a bunch of high interest savings accounts, and it's just a way of holding cash. I put it in because as of now, we talked at the beginning of the show that 4,200 is holding. I need another week or so. And then if I see it continue to hold 4,200, I will start to leg in, which means I'll start taking money out of this Horizons high interest account.
And it's liquid.
It's liquid. You can sell it the day you want, right? And you'll get whatever accumulated, interest, because the stock, as you can see, goes up throughout the month and then pays the dividend out. So we plan on investing pretty soon, so long as 4,200 on the S&P holds, and we'll start cashing that out. But for the time being, we're still 27% cash.
Bloomberg puts the yield on this ETF at around 5%. But don't take my word for it, because yield calculations are obviously tricky.
Yeah. I mean, it's just, like I said, there's no magic to this. It's a few top-rated high interest savings accounts issued by different banks, stuck into one ETF. We just use it as a way to a liquid way of getting in and out of stuff.
I know it's a bit of a broken record. It's my fault. I keep bringing up these stocks, but the first idea is Scotia Bank.
Right, and as I was saying earlier, I know it's December 13th. Scott Thompson's going to talk about their strategic plan going forward.
New CEO, okay.
And what we're looking for, as I said, there is some word about what's going to change in their capital allocation procedures and so on and so forth. So, what are they going to do to increase the returns from their international operations? Are they going to be able to continue to expand their market share in Canada and their wealth management area too? How well have they really done on the acquisition so far of, I guess it was Jaroslawski, and there was
MD Fund Management, I think.
Yeah. But they just did a deal that they're jointly going to partner with Sun Life on in offering, I guess, private credit opportunities to individual investors. I'm not quite sure what the details are on that or how it's going to work, but
private equity investing.
Private equity investing, which, well, for the retail investor, I always worry about by the time it gets to the retail investor, how good is that investment? But
after the lions have fed and etc.
But we have seen some successful players in that. Brookfield being one of them. So it could be an opportunity, but it's going to be interesting to see how that works out. So, as we were saying, you're getting a 7.3% dividend at the current price, which I think is extremely attractive. And with the prospect of their improving their capital allocation procedures going forward, it certainly is an interesting place to be investing right now.
Newmont is your next idea. They finally got a settlement to that giant mine in Mexico after the labor dispute.
Yes, they did. But I think the interesting thing about Newmont right now is the takeover of Newcrest that's planned to happen. I mean, that's huge. That's US $17 billion or something. So that's going to propel them to be, one of the largest in the world at what they do. They're exposed to copper, silver, lead, zinc, all the metals as well as gold, and so and they primarily operate in relatively low risk political jurisdictions. There are some different some that offset that, but overall this new combination will give them more exposure to particularly copper in Canada and Australia, and they estimate that there could be as much as between 500 and 2 billion in synergies over the next 2 to 5 years on this acquisition. So for a stock that's trading at 4.4%, and as I've said in the past, we don't own a lot of gold exposure, but when we do, we try to limit it to some extent. But I think certainly this presents an attractive opportunity to have some exposure, particularly in uncertain times like we're in right now.
And finally, Atco.
Yeah.
Now, this stock, I think, has been under pressure.
Yes, it has. Well, again, it's another yield stock. Currently, it's around 5.5%. And that's because it's primarily utilities. I mean, 53%, they own 53% of Canadian utilities. And that represents about 80% of their earnings. So, from that point of view, they are an interest-sensitive stock like some of the other utilities. But the other side of them, their structures on logistics, that's all owned, and that represents about 15% of their earnings. And then they have these Neltume ports, which are fairly small. So, they also are involved in real estate. And as infrastructure builds around the world, Atco provides a lot of the housing, the logistics. They're also involved in, emergency shelter and things like that. So I think that is a very interesting company. And the other side of it, we've seen a fair amount of insider buying over the last year in Atco. So that's usually a signal that when the stock price is going down and you see the CEO and other insiders buying, I like to see that.
Let's have a look at the markets before we go. Thank you very much, Michael. Centaurus Metals, it's an Australian stock, CTM, is your first idea. What are they all about?
Centaurus is exploring a deposit in Brazil that I think has the potential to be a tier 1 nickel, platinum, and palladium province. The stock has done poorly of late, which is something I like. I think it's cheap relative to its upside. Centaurus is not a stock for somebody who is risk averse. In the first instance, the ongoing exploration could be unsuccessful. In the second instance, Brazil is a country undergoing transition, including the new president, Lula, an avowed socialist and no friend of mining. What attracts me to it is simply the size of the deposit. I think that the deposit has the potential, as I say, to be an absolutely tier 1 platinum, palladium, and nickel deposit.
Let's get to the next one because I think we may have talked about this before. It's G Mining, but it's run by the Gignac family, who are well known as engineers, experts in building mines.
Yeah, the Gignac family has been part of several Canadian mining successes, including in some time ago, IM Gold.
Okay.
They are absolutely top tier mining contractors, particularly in tropical high rainfall terrains. What they are doing now is taking that expertise and putting it to work with themselves as a client. G Mining bought a deposit from Eldorado Gold, the Tocantinho deposit in Brazil, and they are currently fully financed to production. Note that this is both the boring and the risky phase around mining, trying to deliver on time, on budget, nameplate capacity, which is precisely what the Gignac family does well. If they are able to put this thing in production on time, on budget, I suspect that the stock will re-rate substantially higher. And I suspect that we'll know that within the 12-month time frame. I note, too, that the Gignac family would like to apply their financing and construction expertise to other deposits. So I suspect that G Mining will be a company that will attempt, even while they're constructing the deposit in Brazil, they will try to acquire from other companies other deposits which need to be built in tropical high rainfall environments, which is their specialty. I've known them for 3 decades, but I came to know them particularly well in my involvement with Lundin Gold, where G Mining was the contractor building a remote mine, the Fruta del Norte mine, in the tropical regions of the nation of Ecuador. Their performance in this construction endeavor was really, truly extraordinary and caused me to want to invest with them when the opportunity arose for their own account.
What percentage of mines that are actually built across the industry, Rick, would you say really don't ever produce a significant profit? It's very hard, I know, but general.
I'm tempted to say half. Once the money has been spent, people point to the free cash flow generated by the mine and are less obvious about asking the mine to repay the sunk capital costs, one of the great unspoken sins of the mining business.
It's interesting. Yeah, it sure is difficult. I mean, we minimize it, and I suppose it's going to get harder as humanity runs out of easy deposits.
I think that's true. By the way, we haven't run out of easy deposits. We've run out of easy deposits in places that we're comfortable with. There are deposits yet to be discovered, as an example, through the Tethyan belt, from Turkey all the way to Mongolia. But they're in places like Kyrgyzstan, Uzbekistan, Kazakhstan, Afghanistan, Pakistan. And North American investors tend to be shy of places that end in stan. I'm not, but many are.
And what about that big plan to build that mine in Pakistan near the Afghan border, Balochistan? I mean, it's a troubled part of the world, but Barrick is pushing ahead with it.
Reko Diq is a hard deposit, but it's a great, great, great deposit. And Mark Bristow is just exactly the guy to do it. I've watched Mark Bristow be a success in very challenging political and social circumstances, including in Congo, where I watched him be extremely successful with the Kilomoto gold deposit. If anybody can do it, Mark can do it. And it's a wonderful deposit to do it with.
Just finally, sorry, we're tight for time. Equinox Gold, it's another Ross Beatty company, and it has underperformed. Can you remind us why and tell us why you like it?
Equinox has underperformed for a couple of reasons. They had some operational difficulty in their existing deposits, but the big problem has been the fact that they're building a very large Ontario deposit, a $1 billion deposit. And the record of the mining industry in terms of on-time, on-budget completions in Ontario and Quebec in the last 3 or 4 years has been abysmal. The underperformance of IM Gold at Cote Lake, as an example, has put all of the Canadian developers in the penalty box. I believe that Equinox will achieve on-time, on-budget completion. I note, too, that the preferred share issuance is done, so that market overhang associated with financing is gone. If I'm correct, if Equinox completes the construction in Ontario on time, on budget, and achieves nameplate capacity, I think that there's going to be a really, truly substantial re-rate taking place in Equinox.
Right. So I'm just looking at some of the numbers. And so sorry, just to be clear, we're talking about the Greenstone project.
That's correct.
Right. And it's going to be big. 400,000 ounces a year is the plan. Yeah.
It will be transformative for the company. And if they complete on time, on budget, which I believe they will, I think that they'll receive a premium for Canadian production as opposed to, as an example, Mexican production.
Yeah, it's attractive. And you don't have to go into a country like Ethiopia with its, let's say, repressive government. We better jump. Rick, thank you very much indeed. Always a pleasure talking to you.
Always a pleasure. Thank you so much for the opportunity.
Welcome back. It's time now for top picks here on Market Call on BNN Bloomberg. James Telfer is the guest. Restaurant Brands International is top pick number 1, QSR on the TSX. A very popular stock here on Market Call.
Is it? Yeah, good. So QSR, it's, we're talking about Burger King, Tim Hortons, of course, Popeyes, Firehouse Subs, which a lot of people have tried. Very defensive brand, and these are the sorts of things we want to look for in this environment. If you were asked about, do you go with small, mid cap, large cap? Large cap liquid companies that have a defensive market position, we think are going to be attractive over the next 6 to 12 months. And this certainly fits the bill. And you're able to buy it today on a discount because of things like Ozempic or interest rates going higher, knocked off the staples sector, who knows. But there's a really attractive time to own this stock. It's cheaper than some of their U.S. peers at the moment, so there's a bit of a gap to close. And we recently met with the management team, and when you hear about all the levers they have to pull at the business to drive franchisee performance, but also drive brand performance through Burger King renovations or through focusing on PM at Tim Hortons and cold drinks or chicken wings at Popeyes or really expanding Firehouse. We think they have a lot on their plate where they can actually grow same store sales, grow volume, grow traffic, and that'll close that valuation gap for the business. So we think this is one you could sleep well at night and own, and we think it'll perform well if we get into a rocky patch with the economy.
Okay, that's number 1. Number 2 is Honeywell International, ticker symbol HON on the NASDAQ.
Yeah, so we're going large cap. So we own this in our U.S. equity strategy. We think it's an extremely attractive time to look at this company. Despite the fact that it's an industrial business, this is a company that, in a slowing, potentially, economy, this is a company that can grow 4% per year organically without really winking. They have an aerospace division that has huge tailwinds and nice backlog. We're seeing that across the entire sector. We think they'll continue to perform on that. They have a sustainability business that we know is extremely valuable right now in this current environment. Everybody's looking for ways that they can make their buildings or their industrial plants more sustainable. So we think they're going to really benefit from that trend as well. And they have an energy business. So energy as a sector is performing exceptionally well. And so we think they'll do well there, doing valves, measurement, all these things in the energy space. So what's interesting, they brought in a new CEO. So what he's been talking about is right-sizing the business a little bit. We don't think there's going to be some massive changes, but we wouldn't be surprised to see some divestitures from the business and maybe taking that capital and recycling it back into higher organic growing businesses, which would be well received by investors like ourselves and many others that are much larger than us, I believe. So we want to own it ahead of all of these changes, and it's been a weak performer this year.
Okay, and number 3 on this day, Trisura Group, ticker symbol TSU in Toronto.
Yeah, so I had to go a little bit smaller cap with one of my names, just put it on the line, but this is a business that we've followed for quite some time in the insurance space. Power Corp is your big safe dividend, but if you want to barbell that with a company like Trisura, I think you'll be well rewarded at these levels. And so they do a lot of specialty insurance in the US. They have a fronting model, which means they can get one insurance policy across a number of different states and work with one reinsurer on that. And it's been growing like crazy. They've gone from, $1 billion in premiums written. They're going to get to $2 billion plus in the business. And now they're taking a lot of what was successful in Canada, which has been a big growth driver for them, and they're taking that to the US as well in areas that they can take some big market share. We're talking about billions of potential premiums that they can take from other players in the space. So, they had a few hiccups last year. They had to take a write-down, which really impacted the sentiment on the stocks. It's already confusing enough when you get into specialty insurance, but that's impacted the multiple on the stock. But we've gone a few quarters now. They've right-sized that part of their business. We thought they did a really good job of ring fencing it and communicating it to the street, and they're going to learn from that and be better as a result of that. So I think you're getting a chance to buy this thing at a 2.5 times, even lower than that, price to book multiple on a company that can grow 15 to 20% in the insurance space. So that's pretty attractive. And I guess the last thing I'll say on Trisura is that in this environment of higher interest rates, they make decent money on that as well, which helps fund more premiums. So there's a lot to like about the name. Got to get a few more quarters under our belt, I guess, to get that multiple back up. But we think they'll execute on that in a tough environment. So I don't think whether the economy's the leather's ripping off the ball or not, I don't think that matters for the catalyst to hit with Trisura Group.
Okay, those are James Telfer's top pick, Restaurant Brands International, Honeywell International, and Trisura Group on the TSX. James, thank you a great deal for joining us.
Yeah, thank you very much.